Your first rental will pay you $200 a month and take every weekend you have. Somewhere above you, families collect rent from entire skylines without ever touching a wrench. Level 1. The Saver. Every empire on the skyline started with somebody's boring paycheck. This level is not about property at all. It is about the money you refuse to spend. You earn a normal salary, and the houses on your own street have quietly become luxury goods. The gap between what you make and what they cost is the first wall. Median U.S. home price. $422,000 existing homes, 2025. The median American home now sells for more than $400,000. At that price, the traditional 20% down payment is a five-figure test most people never pass. So you live below your income on purpose. Same apartment, same aging car, while a fixed slice of every paycheck disappears into an account you have promised not to touch. The down payment is not one number. Government-backed loans let owner-occupants in for a fraction of what investors pay, and that difference decides your entire entry strategy. While the money builds, you study. Loan terms, rent comps, property taxes, insurance. You run numbers on houses you cannot afford yet, and slowly the numbers start talking back, saving $600 a month. 2 years to reach $15,000. $600 a month becomes roughly $15,000 in 2 years. That is the honest timeline, and the people who skip it usually end up buying the first mistake they see. Eventually, you sit across from a loan officer who reduces your life to 3 numbers: income, debt, credit score. At this level, the bank is grading you, not your deal. Max debt-to-income ratio. 43% of gross monthly income. Lenders generally want your total monthly debts under about 43% of gross income. Every car payment and student loan quietly shrinks the building you will eventually be allowed to buy. Then one day the letter arrives with a number printed on it. It is smaller than you hoped for. It is still the first key anyone has ever handed you. Level 2. The House Hacker. You cannot afford a pure investment property yet, so you do something smarter. You buy a home and quietly make your tenants help pay for it. You tour a tired duplex on the cheap side of town, 2 doors under one roof. You will live in one side, and a stranger will help fund the other. FHA minimum down payment, 3.5% owner-occupied, up to 4 units. Because you will live there, the government treats you as a homeowner instead of an investor. An FHA loan opens the door for just 3.5% down. Here is the actual math. The tenant's rent covers more than half of the mortgage, and your cost of living drops below what your friends pay for one-bedroom apartments. You move in with a mattress and a toolbox. Your tenant lives 1 wall away, which means every problem in their life is now also a problem in yours. The furnace dies on a freezing January night, and the phone call comes straight to you because you are the landlord now. There is no one further up the chain. Weekends disappear into paint, gutters, and hardware store runs. On paper, you own an asset. In practice, the asset owns you, and it is billing you by the hour. What looks like passive income is really a part-time job. The internet calls this passive income. It is not. At this level, it is a part-time job with a mortgage attached, and the hourly wage works out below minimum. After a year, you move out, rent your old unit, and the duplex becomes a pure rental. 2 rents now flow in every month, and 1 small number is left over. First property cash flow, $200 per month. After the mortgage, taxes, insurance, and repairs, the building clears about $200 a month. It is almost nothing. It is also living proof that the machine works. More importantly, you have learned to underwrite, to look at a building and see incomes, expenses, and risk. That skill, not the duplex, is what you actually bought. Level 3. The Landlord. One property is an experiment. Now you start buying doors on purpose, and you find out why most small landlords quit within their first few years. You take the equity and savings from the duplex and close on a true rental property. No living in this one. The numbers must survive completely on their own. The 1% rule. 1% monthly rent versus purchase price. Old landlords use a rough filter. Monthly rent should approach 1% of the purchase price. In most expensive coastal cities, almost nothing passes, so you learn to hunt elsewhere. New landlords count the mortgage and call the rest profit. Veterans budget close to half the rent for everything else, because roofs, vacancies, and water heaters do not ask for permission. Then you place the wrong tenant. The rent stops, the excuses start, and you discover that eviction law moves slowly while your mortgage payment does not move at all. Average cost of an eviction: $3,500 plus months of lost rent. A typical eviction runs several $1,000s in legal fees and repairs, plus months of lost rent. One bad screening decision can erase an entire year of cash flow, so you study the failure list. Almost nobody loses a rental to a market crash. They lose to people problems, neglected buildings, and slow bleeds they never budgeted for. You respond by building systems. Written criteria, background checks, a licensed handyman, a separate bank account for every property. Boring paperwork, which is exactly what survival looks like here. In a strip mall office in April, an accountant shows you something strange. Your rentals made real money all year, yet the tax return says they barely earned anything at all. Residential depreciation: 27.5 years. The tax code lets you depreciate a residential building over 27.5 years. That paper expense shelters your rent, and it is the first advantage wealth gets that wages never do. By the end of this level, you hold 3 or 4 doors. The cash flow is finally real. So is the ceiling, because your savings refill far slower than deals appear. Level 4. The portfolio builder. Saving a fresh down payment for every single house would take decades. The investors who actually scale learn to recycle the same money over and over. You start buying what nobody else wants. A dated house with a sagging porch, priced below everything around it, because the value nobody can see yet is the value you get paid for. The strategy is called BRRRR: buy, rehab, rent, refinance, repeat. Done correctly, the bank's refinance returns nearly every dollar you put in, and you still own the house afterward. The catch lies inside the renovation. Contractors vanish, bids double, permits stall. Every week of delay is borrowed interest burning, and you learn to manage trades like a foreman. Everything hinges on one stranger with a clipboard. The appraiser walks your finished house for 20 minutes, and their number decides whether your money comes back out or stays buried. Conventional loan limit: 10 financed properties per borrower. Then you hit a federal wall. Fannie Mae caps most borrowers at 10 financed properties. Past that point, the comfortable 30-year mortgages you started with simply stop being offered. So you graduate to lenders who never ask about your salary. They ask about the property's rent instead, because at this level the building is the borrower, not you. DSCR minimum: 1. 25x rent versus debt payment. These DSCR loans want the rent to cover at least 1.25 times the debt payment. Weak deals get rejected by simple arithmetic before any human says no. A few years of recycling capital produces this. On paper, you are approaching millionaire territory. In your checking account, it still looks like a decent side income and nothing more. What looks like 9 rental houses is really one fragile machine. You also feel the fragility now. One roof, one eviction, and one vacancy landing in the same month can swallow a quarter of your annual cash flow before spring arrives. And you notice the real bottleneck is you. Every door adds phone calls, and single houses only scale as fast as your evenings. The next level abandons houses entirely. Level 5. The commercial buyer. Past 4 units, the rules change completely. Buildings stop being priced like homes and start being priced like businesses. This is where real leverage begins. You walk a 12-unit brick building with a broker who speaks entirely in acronyms. It is nothing glamorous. It is also worth more than your entire portfolio of houses combined. The commercial line: 5+ units, was commercial property. Anything with 5 or more units is commercial property. Different loans, different appraisals, entirely different math. Your track record with small rentals is your only ticket through this door. Here, the appraisal ignores the house next door entirely. A commercial building is valued on the income it produces, which means the value is something you can personally change. The formula is simple. Net operating income divided by the market's cap rate equals the price. Learn to move that top number, and you can manufacture value on command. So you renovate units as leases turn, add laundry income, and cut a bloated insurance bill. Small, boring operational moves, executed one door at a time for 2 straight years. Forced appreciation, $205,000 value created. A $100 rent increase across 12 units adds over $14,000 in annual income. At a 7% cap rate, that is roughly $205,000 of new value. Your bank relationship changes too. A commercial lender studies your operating statements across a conference table, and for the first time, you are negotiating terms instead of just accepting them. You also learn a word that matters here: recourse. On most loans this size, the bank can still come after you personally, so every new deal stacks onto the same signature. Then you hire a professional management company and finally put down the wrench. A slice of collected rent buys back your weekends, and the numbers still work without you. On paper, this level makes you genuinely wealthy. In reality, most of that wealth is trapped inside brick and cannot buy groceries. Getting it out requires other people's money. Level 6. The syndicator. You have run out of your own money, but you have not run out of deals, so you start buying buildings with other people's savings. You stand in front of doctors, engineers, and business owners with a slide deck. You bring the deal and the work. They bring the capital. This arrangement is called syndication, accredited investor threshold. $1 million net worth, excluding primary home. Securities law decides who you may raise money from. Accredited investors need $1 million of net worth outside their home, or $200,000 in annual income. The standard structure looks like this. Investors get paid first, up to a preferred return, and you earn your larger share only after their money is already working. Raising the first $1 million is brutal. You are selling trust with no institutional name behind you, and every investor is quietly asking one question: what happens if you are wrong? Leverage of other people's money. $20 million asset controlled. Then the flywheel turns. $5 million of raised equity, combined with bank debt, controls a $20 million apartment complex. You have effectively skipped an entire decade of saving. You close on 150 units in a single afternoon. More doors in one signature than your first 10 years combined. That signature also carries other people's retirements. Your job changes again. No tenants, no toilets. You manage the manager, chase the budget, and write investor updates every quarter, including the ones that are hard to send. This level has a graveyard. When interest rates doubled after 2022, syndicators holding floating rate loans and thin reserves watched years of investor equity evaporate in a few months. Houston foreclosure, 2023, 3,200 apartment units lost. In 2023, a single Houston sponsor lost more than 3,000 apartment units to foreclosure when its rate caps expired. The investors behind those deals lost essentially everything. So the survivors underwrite like pessimists. Fixed-rate debt, oversized reserves, boring rent assumptions. At this altitude, conservatism is not a personality trait. It is the entire business model. Level 7. The developer. Everyone below this line buys buildings that already exist. Developers create them from bare dirt, and the risk curve bends violently in both directions. You stand on a weed-covered lot behind a chain-link fence. To everyone else, it is nothing. To you, it is 200 apartments that simply do not exist yet. First, you must win permission. Zoning boards, traffic studies, community meetings where neighbors line up to oppose you. Nothing gets built in this country until the politics says yes. Entitlement timeline: 2-4 years before construction. Entitling land commonly takes years before a single shovel moves. You carry the property, the lawyers, and the consultants that entire time while the project earns absolutely nothing. A mid-sized apartment project budgets like this. Land is actually the small line. Construction and the invisible soft costs, meaning architects, interest, and insurance, quietly consume everything else. The construction lender wants one more thing before funding: your personal guarantee. If this project fails, it does not just fail, It reaches back for everything you built below it. Then a crane rises with your name on the permit, and for 18 months you burn borrowed money every single day against a delivery date you do not fully control. Target development margin: 15–20% profit on total cost. Developers target a profit margin around 15 to 20% of total cost. The finished building must appraise well above what it cost, or years of work return nothing. What looks like a rising tower is really a timed bet. A skyline crane looks like triumph. It is actually a timed bet that rents, interest rates, and construction costs will all cooperate for 3 consecutive years. Often they do not. Delivery day is not the finish line either. Now 200 empty units must fill, one lease at a time, while the construction loan clock keeps running in the background. When it works, the payoff is enormous. You created value that never existed before, refinanced into calm long-term debt, and the tower quietly pays you for decades afterward. Level 8. The institution. Above the developers sits a quieter world. Here, nobody tours properties anymore. They allocate capital, and single buildings are reduced to line items. You no longer chase deals one at a time. You raise a fund, a pool of committed capital, and deploy it across dozens of properties under a single written mandate. Blackstone, Real Estate AUM. $315 billion plus assets under management. To understand the ceiling here, look up. Blackstone alone manages over $300 billion of real estate, more than the property markets of entire mid-sized countries. Your investors change species entirely. Pension funds, endowments, insurance companies. People managing teachers' retirements now sit across your table, and their diligence takes months instead of phone calls. Fund economics are standardized across the industry. A yearly fee keeps the lights on, but the real prize is carried interest, a share of all profits above the hurdle. You stop buying buildings and start buying companies that own buildings. 200 properties can change hands in one transaction that never appears on any public listing site. Invitation Homes Portfolio. 80,000 plus single-family houses. This is how single firms came to own staggering inventories. Invitation Homes alone holds roughly 80,000 American houses, assembled largely in the years after the 2008 foreclosure wave. Your true weapon at this level is cheap money. Institutions borrow at rates ordinary families never see, and in real estate, whoever borrows cheapest can outbid everyone else forever. Some peers take the other exit and go public, turning buildings into shares that trade by the second. Liquidity in exchange for answering to Wall Street every single quarter. The work itself becomes strangely abstract. You approve memos, not mortgages. Weeks pass without seeing a property, because at this scale, real estate is a spreadsheet with an address. Something else happens quietly along the way. Decisions made in your conference room now set rents for thousands of families you will never meet. The power stopped being personal levels ago. Level 9. The Dynasty. The final level is not about buying more. It is about never selling, and about making the holdings outlive the person who built them. The empire now gets its own quiet headquarters, a family office with no customers and a single client. Its only job is making sure the holdings outlast everyone in the room. The 1031 Exchange, 1921, written into the tax code. The playbook is older than television. Section 1031 of the tax code, written in 1921, lets investors swap one property for another and defer the tax bill indefinitely. Dynasties trade buildings upward for entire lifetimes without ever triggering a taxable sale. The strategy has an unofficial name inside the industry: swap until you drop. Deferred tax at death. $0 stepped-up basis for heirs. Then comes the ending. When the owner dies, heirs inherit at current market value, and decades of deferred capital gains taxes are legally erased down to zero. Written out plainly, the entire system fits on a napkin. Borrow instead of selling, exchange instead of selling, and let inheritance law do what a sale never could. The oldest families barely operate buildings anymore. They own the land underneath and sign 99-year ground leases, collecting rent on dirt while other people take the risk above it. The Durst Organization, 1915 founded, still family-held. This is not theory. The Durst family has built and held Manhattan real estate since 1915, and their towers still anchor the skyline more than a century later. Walk through any major city and read the buildings: Rockefeller, Durst, Related, Tishman. Skylines are not collections of buildings. They are family ledgers written in glass. Somewhere in the tower, the next generation is being trained on the same underwriting you learned at level 2. Empires rarely fail from bad markets. They fail from bad heirs. And that is the top of the ladder. It is the same game as your first duplex. Income against expenses and debt against patience, played across generations instead of months. Climb back down for a moment to that first duplex and the $200 it cleared. Every skill on this entire ladder was already hiding inside that small check, because the honest lesson is unglamorous. The ladder is climbed with underwriting, patience, and reinvested cash flow, and almost never with the shortcut currently being sold to you online. Most people will never climb past the third level, and a paid-off duplex is still a quiet fortune. But at least now you know how high the ladder actually goes.